I'm sure you've heard the news talk about equity markets or shareholders. These terms pop up everywhere, on TV, in newspapers, and even in casual conversations about the economy. But have you ever stopped to wonder what they really mean and why they matter so much in the world of business and finance? But what does equity actually mean for you and me? Is it just a buzzword, or does it have a real impact on our lives and financial futures? Let's break it down together and see how equity connects to everyday people, not just big investors or Wall Street professionals. Welcome to A2Z of Economics. Here, we make complex financial concepts simple and relatable, so you can feel confident navigating the world of money and markets. Today, we're diving into equity, a word you'll hear a lot when people talk about companies and investments. So what is equity? In the simplest terms, equity represents ownership. It's the value that would be returned to a company's shareholders if all the assets were liquidated and all the company's debts were paid off. Think of it as the long-term money a company raises from investors by selling shares. When a business wants to grow, launch new products, or expand into new markets, it often needs more money than it can borrow. That's where equity comes in. Investors provide funds in exchange for a piece of the company. When you buy a share, you become a part owner of the company. It doesn't matter if you own one share or thousands, you now have a stake in the company's future. Your fortunes rise and fall with the company's performance. That means you get a slice of its assets and profits. If the company does well, the value of your shares can go up, and you might even receive a portion of the profits in the form of dividends. If the company struggles, your shares could lose value. Shareholders, people who own these shares, have special powers. They're not just passive investors, they have a voice in how the company is run. This includes voting on major decisions, such as mergers, leadership changes, and company policies. They can vote on important decisions like who runs the company. This democratic process ensures that those who have invested in the company have a say in its direction and future. And sometimes, they receive a share of the company's profits, called dividends. Dividends are like a reward for being a shareholder, and they can provide a steady stream of income in addition to any gains from the rising value of your shares. Unlike loans or debt, equity doesn't have to be paid back. The company isn't obligated to return the money to shareholders, and there's no interest to pay. This gives businesses more flexibility and less financial pressure. So the company can use that money for as long as it wants. This long-term capital can be crucial for innovation, research, and building a strong foundation for future growth. If another company wants to take over, it needs to make an offer good enough to convince the shareholders to sell. This means shareholders have the final say in major changes, protecting their interests and ensuring fair value for their investment. So next time you hear about equity, remember, it's all about ownership, having a voice, and sharing in a company's success.